Good morning, Amsterdam. Good morning, Berlin. Good morning, London. Good morning, Paris. Good morning, Frankfurt. Ladies and gentlemen, esteemed guests, dear friends, welcome to the second Future Europe conference. We are only 2 weeks away from the elections of the next European Parliament. The elections will shape EU policies for the next 5 years. After the elections, we may face major changes in important areas such as international trade and finance, climate policy, defense and migration. Yesterday, the head of the European member states met in Sibiu to discuss the future of Europe in a world that has changed in the past few years. Great Britain is going to leave the European Union. The EU's relations with America and Russia are under pressure. China is pursuing its goals to become the world's most important economy. According to elections forecasts, Euroscepticals' voices will be louder. Nationalist parties will be represented and more strongly in the next European Parliament. What does it mean for Europe's position on global issues such as climate change, social inequality, trade policy, defense and security cooperation? And how can the European Union continue to guarantee stability, prosperity and peace? These are just some of the questions we would like to address today with the esteemed speakers. Before I turn over to the two keynotes, I would like to thank our partners Deloitte, ING, Société Générale and Frankfurt Rhein-Main, and more than 35 speakers, and of course all the supporters. Thank you for the great cooperation in realizing our joint project, Future Europe. Now I would like to ask for your attention for the keynote of Peter Praet, member of the Executive Board of the European Central Bank.
Thank you for inviting me to open this important conference. It is common today for observers to assess the future of Europe with a sense of pessimism. The long years of crisis and the rise of Euroscepticism appear in the eyes of many to have set the cause of integration back. Some now question whether Europe's citizens would be best served by less integration, not more. Partly these questions come from idealized memories of the past, in particular when countries had their own currencies. But we should be clear that things were not better before EMU. They were worse. It's easy now to forget that the single market was a response to the economic stagnation and high unemployment of the 80s, and the euro a response to monetary disorders. Yet, doubts about the future of Europe also reflect real concerns about our monetary union. The notion that the euro provides stability and security has been weakened by the gaps in our governance framework. In this context, it is not surprising that claims that countries would be better off outside of the euro find a sympathetic audience. The long-run solution most likely involves deeper fiscal integration, and it is important that the debate is moving forward in this area. But ambitions in the short run are relatively limited, and actions are needed today to rebuild trust in EMU. What we can accomplish now is to complete banking union. We know from the US that an integrated banking sector is critical for stability and risk sharing in a well-functioning monetary union. The progress made in building the SSM has moved us closer to this aim. But it is clear that for deep cross-border integration to develop, effective institutions for public risk sharing need also to be in place. Without such institutions, incentives will remain for national authorities to ring-fence capital and liquidity within subsidiaries, and will not achieve the cross-border integration and private risk sharing that are necessary for EMU to thrive. This is why completing the framework for bank resolution and deposit insurance cannot be delayed any longer. This will lead to greater private risk sharing and lessen the need for fiscal risk sharing. Such decisive steps to strengthen the monetary union would come at an opportune moment for Europe. This is because even as Euroscepticism rises, the external case for working together has rarely been stronger and more visible to the public. It is now plain to see that the rules and norms which have governed international relations since the Second World War are being challenged, replaced by a new power politics where large economies try to impose their will on smaller ones. In such a world, it is undeniable that the European Union amplifies the sovereignty of its members. In parallel, Brexit has served to underline the pros of membership and the cons of being outside. It is now established that leaving the European Union presents a trade-off. Countries either have to follow the rules they once set, or they have to accept a diminished level of market access and ultimately lower welfare for their people. This renewed visibility presents an opportunity for the European Union to reconnect with the European public and re-find its raison d'être. In this spirit, with European elections approaching, those who believe in Europe have two imperatives: to promote and defend the European Union where it is working and to fix it quickly where it's not. I hope this conference can help carry that debate forward. Thank you.
Thank you, Peter. We now are going to hear the keynote of Philip Hildebrand, Vice Chairman of BlackRock, London.
Good morning, and please accept my apologies for not being able to be in Frankfurt in person today. As Henry Kissinger recently said in London, we live in times of grave uncertainty. There are many reasons for this, of course. Symbolically, nothing could mark the gravity of the situation more than a president of the United States who openly embraces anti-European political rhetoric. It is the very gravity of this moment that demands more than ever the need to continue to strengthen and solidify the unique project of European integration. We all know how hard this is. There are formidable challenges that face Europe, not least how to avoid becoming excessively dependent in the digital or indeed in the financial space on either the United States or China. But we must remind ourselves that contrary to what many outside of Europe want to think, we have much that we can build on. Europe is the world's largest economic bloc. Europe is built on diversity and sound democratic political values. Europe has a highly educated workforce, and Europe can certainly compete globally with its innovative firms. And Europe has shown that despite what were at times severe political difficulties, it can respond in times of crisis by way of institutional innovation and bold decision-making. Of course, we face important economic challenges, but they are no greater than those of the other major economic areas. Yes, we struggle with growth and productivity, but the good news is that we can unlock significant potential by simply persevering on European integration and on completing the single European market. To illustrate the potential here, one recent estimate suggests that removing all EU trade barriers could raise the EU's income by up to 14% over 10 years and double intra-EU trade. Moreover, completing Europe's banking and capital market union would unlock tremendous further potential and lessen the reliance of foreign capital to fund innovation in Europe. Deeper and more integrated financial markets would also mean a greater ability to absorb and diversify risk in the event of a future crisis. I would encourage all of you to think hard about this point. Finishing the work around the banking and capital markets union is critical not just to unlock growth, innovation, and productivity potential, but also to build resilience. We are now in the 10th year of a global economic expansion, and there is no need to be overly fearful of an imminent downturn. In fact, market sentiments about Europe are almost certainly too pessimistic at this moment. Nonetheless, no expansion can last forever. We are in a classic late cycle phase, and at some point, a new crisis will hit the European economy. When that day comes, structural resilience will be critical. The reason for this is simple. It will be very difficult during the next critical downturn for monetary policy to do the same amount of heavy lifting that the ECB was able to do during this past crisis. Moreover, the same is true, at least to some extent, for fiscal policy. Therefore, the prudent risk management answer must also be to use the time we have left in this cycle to restore Europe's growth and innovation, pushing on with the unfinished work on the single market, on banking union, and on capital market union. This will require further institutional change, and it will certainly require political courage. But these efforts will prove to be sound investments in enhancing European prosperity and in making us more resilient in the next downturn, let alone the next crisis.
Thank you, Philip. Ladies and gentlemen, we are now starting with the local sessions, and we will get back together in about 40 minutes. So, see you later.
Vielen Dank, Herr Maleki. Schönen guten Morgen von mir. Ulrich Barz ist mein Name von HR Info, vom ARD.
So, good morning, ladies and gentlemen, here in London. It's my pleasure to chair this first session this morning, which is, of course, a real sign of deep commitment that you got out of bed so early to be here. And we have some time to discuss some of the issues. I know that my two colleagues here, Ray Newton-Smith and Eric Menges, will come. Menges is on his way from the airport. And we will also have... here he is. Okay, welcome. And then Ray Newton-Smith will also be on the European panel, which follows our local panel here. This is the second time we have a conference of this kind. We started this last year, and I think it was a great success. Last year we had Minouche speaking for the LSE, and especially in Paris, everyone was on the floor loving her so much. So that was a good thing for LSE. So today, the early morning session here is we will talk about the issue of finance and how it can contribute to, good morning, how it can contribute to an inclusive and sustainable economy. And I would like to start this by asking Lorenzo Codongo, who has been working in the public finance field for many years, the Italian Treasury and many other things, and now has a very interesting research unit here in London. Lorenzo, what do you think about what our two previous speakers have said about the role of monetary policy and the ECB, especially given that we are in a late phase of the boom cycle?
Yeah, it's a very good question, and you know, I've been asked to talk about finance, but finance has many dimensions. So I try to kind of organize my comments in different kind of sections, and I would start with a kind of macro picture, which is probably what you are trying to ask. And clearly, when we talk about the macro dimension on our finance in Europe, we are talking about both monetary policy on the one hand and fiscal policy on the other, how they interact, how the stability of the Eurozone is impacted by this. First of all, finance must have a purpose, so must be useful for the real economy and must be channeled in a proper way. The Eurozone, we know, has been pretty late in delivering any accommodation and using its balance sheet to stabilize the economy and inflation expectations, and it struggled to deliver the proper degree of policy accommodation. So it came late. It did little initially, and now it has to do more, effectively. So the policy mix, to some extent, remains somewhat restrictive, at least in some countries. And real interest rates, to some extent, are still probably too high relative to nominal growth, at least in some countries. Let me give you an example. In Italy, total loans over nominal GDP is 74.5%. And it was 97% before the 2011 debt crisis, and so it has declined quite substantially. So the degree of the finance available for the economy has shrunk. In euro terms, loans are 17.4% below the pre-crisis peak, and financing of the economy is simply not happening in some countries. So European integration and the reform of governance is still somewhat short of what would be desirable. You mentioned what's my reaction of I think the two initial speakers, Philippe de Brand and Peter Pride. I think they touched the very important themes of governance and the way to unlock potential in Europe. Clearly, finance is one of these areas. I think the problem of integration and governance are strictly linked, and they are linked with the political problems Europe is facing right now, the rise of anti-establishment populist governments, and notably in my country, Italy, but also in other places. Now, I think there is an intrinsic instability in the financial system in Europe that needs to be addressed somehow. When Draghi here in this university, by the way, in 2011 gave the very important speech on OMT, delivered and effectively was instrumental in achieving some stability for quite a while. But we have to acknowledge that the situation in the Eurozone is intrinsically fragile and unstable, because effectively countries are issuing in a foreign currency, a currency that they have no full control. And therefore you can have phenomena like flows of funds that might become destabilizing, as we have seen in many countries during the debt crisis in 2011.
Let me interrupt you there, because I know this is a point of view that is maybe particularly popular at the European Institute, coming from Paul de Grauwe, that countries issue their debt in foreign currency. I think it's total bullshit. It's our currency, it's a euro currency, it's not a foreign currency. This is just not it. The currency is issued by the ECB. It is issued for the euro area as a whole, and then it goes wherever it is. There are supply and demand conditions for borrowing, and you can always have more if you need it, and the banking system needs it, and as long as it is within the overall aggregate supply of money. So there's nothing foreign about this. This is kind of similar to the idea that the euro area is a fixed exchange rate area, which is also not true. The point why it's not true is that foreign exchange reserves have absolutely no importance. And if you talk about foreign currencies, then foreign exchange reserves is what matters in the balance sheet of a central bank. So I just wanted to put a counterpoint to that.
Can I reply?
Yes, please.
Well, I think the proof is in the pudding, as they say here in the UK. So basically, we have seen already in 2011 that the situation is not stable, in a sense that you can have severe capital flows within the Eurozone, simply because there's no backstop from the ECB. Now, certainly in some capitals, this might be seen as a way to prevent moral hazard, which is fair, but it also leaves the situation intrinsically unstable, in my view, which is penalizing the Eurozone economy and the real economy, because that impinges on the availability of finance on a continuous basis.
I would agree that it is more fragile, and I think Peter Pratt made the point correctly that with a properly working monetary union, you need the banking union, capital market union, and all that. But it is not a foreign currency. The logic, the economic logic of that is very different. And I think that is important to understand. And of course, it is also true, which is what the other speaker said, that you need to do certain structural reforms to make it attractive to bring the money. Now, do you think it's a foreign currency if you have to go to Barclays Bank to take out a loan, just because you can't make the money yourself at your living room? I mean, that's the kind of logic that these foreign currency people say.
I think it is a semantic difference, in a sense that the meaning of the fact that European countries are not issuing in their own currency is that there is no backstop by the central bank.
No, you don't issue your own currency as a country. You get the currency in the country you live in, which is the euro area. And
okay, but again, this is a semantic difference.
No, it's
the
not.
reality is that there is no backstop.
No, it's not, because what it means is implicitly, the logic behind that is that if you think countries issue their debt in their own currency, implicitly means they can issue as much debt and create as much money as they can. And you, by all people, know perfectly well what a terrible disaster that was for Italy. And what we really have to understand with the introduction of the euro, this has changed. That means also the economic practices have changed, the financing practices, the taxation practices have changed. And if you are talking about foreign currency, you are inevitably denying that kind of adjustment to the integrated area, economically, monetarily, and financially, that the euro area is.
Do I have time to reply or no?
maybe we come back to this later, but anyhow, I would like to ask Mr. Menges, who's just come from Germany, and you may have not heard the initial speech by Peter Pratt, but the point was made that Europe needs to seize the opportunity now to go deeper. And would you like to say something how this is seen in Germany, particularly as we have also heard that we are in a late phase of the business cycle, and so the next crisis is around the corner, and next time what capacities will we have?
Well, first of all,
debate in Germany about that?
Okay, well, thank you. First of all, a very good morning. Sorry for running a little bit late. Had to look after a few sorry faces at City Airport. Frankfurters leaving London after last night's match. But I don't want to talk about football today, but rather this is a business conference. I'm not a monetary expert. I'm not a banker. I'm a sponsor of this conference because I think it's very important. And I would like to say a few words about why we are sponsoring this conference. My name is Eric Menges. I am the CEO of the Inward Investment Agency for Frankfurt and the greater Frankfurt Rhine-Main area. My region is one of the leading financial centers on the European continent. It's home to the European Central Bank. It has the world's best connected airport by an official connectivity index. and is easily the most international place we have in Germany. My personal role and the role of my organization is to attract foreign businesses to our region. Not by offering financial incentives or tax incentives, but through providing hands-on support and in-depth information. Don't let anyone fool you with stories or myths about how difficult or unattractive it is to work and live in Frankfurt. There's a lot of stories going around. We live a great lifestyle, which is not better or worse than here in London, but it's simply different, and it's simply good. In all openness, my business has been booming like nothing we've ever seen before since the Brexit referendum. You could even go as far as saying that my organization and my region is one of the big Brexit winners. All this said, I've come here this morning to say that I don't like Brexit. And I wish there was another way. We are here at the London School of Economics, but wherever I hear talks and discussions about Brexit in the UK these days, it is often about how Germany is against Brexit because this or that industry may lose, or this or that European business may struggle in the future with Britain leaving the common market. Now, I was born in Frankfurt. I'm a born and bred Frankfurter, so to speak. I live in the middle of Germany. And I do think I speak on behalf of many of my fellow Germans when I say that easily the most important reason, and I'm aware that this is not a reason that is often communicated through the media, be it the papers or radio or television. I think that easily the most important reason why I and why we don't like Brexit is that we simply like the Brits, and we would love to have them continue to sit at my, or rather, the European table. The future of Europe, which is the theme of this conference, I think it is a great theme. How could I not be a sponsor of this conference? So let's all be a part of it, and the best of success to this conference and to the speaker and today's proceedings. Thank you very much.
Well, thank you very much, and certainly at the LSE we are very appreciative of this sponsorship. And let me also say that this afternoon we have our last session as a direct city-to-city exchange between Frankfurt and London and LSE. So in that sense, certainly Germany or Frankfurt is a great city, and it's different. We also have different views of some of things. Unfortunately, Rain isn't here yet, but it would be interesting to hear how she would see these opportunities. But Lorenzo, if I come back to our discussion and ask you, where do you see the main risks that are ahead of us, especially given that we are at the late stage of the cycle, and what instruments will we have?
Well, we are in a kind of late phase of the cycle, meaning that there are major differences in economic performance in countries within Europe, and that sometimes for economic reasons, some other times for different reasons, which is the case of the UK, I would say, populism and anti-establishment parties are on the rise. We will see how the European elections are ending up. But I think this is the kind of late wave of the crisis that Europe suffered in the past, and now it's becoming a social and political crisis, which is even more worrying, in my view, to some extent. And again, to provide the stability for finance and for economic activity within Europe, and especially the Eurozone, I think we need to find a way to speed up European integration and find ways, as Peter Praet mentioned, and even Phil Hildebrand, to leverage, unlock potential in Europe which means basically finding solutions. And because if you look at the governance process at the moment in Europe and in the EU, and especially in the Eurozone, it seems stuck. Has been stuck for a few years, and so we need to move forward.
Mr. Menges, you said that your business has been booming enormously in recent time. You said since Brexit. I don't know if it is related or not, but there are two theories why Germany is booming. One is because it has done all the necessary structural reforms, and the other is that because it's the safe haven in an uncertain world, all the capital has gone to Germany, and of course Frankfurt being the capital center of it, it's all gone to Frankfurt, and that is part of the boom that is carrying forward Germany. Do you have any views on that?
Well, I think, I mean, we often get asked, what are the drivers behind these decisions? You've seen a lot of the banks making decisions in favor of Frankfurt. But it's not just the banks, so it's a range of businesses. It's automotive, it is life sciences, it's IT. It has certainly something to do with being a safe haven, but not just for financial services, political stability, business, economic outlook. Whilst we have the latest estimates for tax revenue by the government going down a little bit, but it's still it's the surplus that's going down. It's still pretty solid. So that has certainly been one of the key drivers, and it has clearly put Germany on the map as one of the preferred alternatives after the UK, because before Brexit, London and UK was for many international companies the natural go-to place in Europe. And that we see that at least we are now sort of moving up the list of alternative locations, and that has been very beneficial to Frankfurt, and as far as I know, to other parts of Germany as well. But now in the wake of the Brexit decision, certainly for Frankfurt with regards to immediate effects from the financial services industry, but we can see it spill over into other areas just as well.
And in many countries in the European Union, we have seen that during the last decade, there has been a reduction in public investment, infrastructure investment. And has that been any better in Germany? Or is, say, the success of Frankfurt region that you mentioned, is that because there was less reduction in infrastructure investment than in other parts of Germany?
Well, I don't know if it's less, but certainly there has been a lot of investment. If you follow the news, there's been a big announcement on Frankfurt Airport opening up, well, sort of ground laying for a new terminal number 3. So that is a major infrastructure investment that has a direct impact on the economic activity. But the main investment has really gone into providing housing, because it is such an attractive area. So housing is very important, but what is critical to that is that you are able to link the region together, and that's part of my role as well. So you don't just look at the city of Frankfurt, but you look to the neighboring cities as well. And if they're not connected by highly efficient infrastructure, it's simply not going to work, having the influx of all these international companies in a region like, in a comparatively small city like Frankfurt. So the region is part of the whole story, and I think infrastructure plays a great role in it. This said, there are always ecological reservations as well that come into play when you talk about expanding autobahns, expanding railways. So that is obviously always on the agenda as well. So that's been quite a political discussion on putting new infrastructure in place.
And Lorenzo, in Italy, if we come to the end of the cycle, what is that can be done to stimulate demand? And are the problems in Italy lack of demand, or are they lack of productivity, insufficient infrastructure, and related issues? And how is it related to public finance?
Well, it is. It's a very complex problem. If I can actually address that in a nutshell, I was mentioning that effectively policy is still relatively tight in some countries in the euro area, and certainly this is the case in Italy. And the proof of that is that effectively the transmission of monetary policy doesn't really translate into proper financing for the economy. Now, how responsible is this government for the mess, the current mess? Yes, hugely responsible in my view. It is basically moving in a direction which is 180 degrees in opposite to what should be the case. So basically they are exactly doing the opposite of what would be desirable in the current situation, and which highlights the problem in Europe, because Europe is still not a complete entity in a sense that there is no, I mean the policy is still very much local, and there is very little that can prevent a government like the one in Italy to behave like a maverick. And the problem is that effectively you cannot move sovereignty at the center without full agreement and a full integration process, which I think is absolutely necessary. And I think you have to, Europe needs to find a proper way to balance devolution, so local responsibility, and at the same time centralization of some functions, because otherwise you always end up with governments somewhere, somehow. It was Greece in the past, today is Italy, maybe tomorrow is France, that behave in a completely different fashion compared to the remaining part of the area, and there's very little that Europe can do from a governance point of view to prevent that.
Rain, welcome to this panel. We are still in London, but in 5 minutes you will be in Europe.
Very good.
And
it'll be a very nice place to be.
yes. We have had already some hefty discussions here about whether in the euro area countries can issue debt in foreign currency, or are they issuing their own currency, which is my point of view.
Yeah.
But we have had a speech by Peter Pratt and also a gentleman from ING Hilband, who have emphasized that we are kind of coming towards the end of the boom cycle. And what are the tools that Europe would have to counteract when the next crisis or recession comes? Now, I wonder if you have a view on that, but more than that, I think in the UK there's a double down on this with Brexit. So what are your views on this conjunction?
Well, I mean, I think, you know, it's true in Europe, it's certainly true in the UK, you know, probably more so when you're looking at sort of interest rates. Obviously, they're already at low levels, so there isn't much, you know, there's not that much room to maneuver. And I think there's, you know, there are certainly those who look at what the bank has done and said they should have put up interest rates, you know, when the economy was stronger, because, you know, we now don't have much leeway, you know, should we see an economic downturn. I mean, I think it's, you know, they've had a challenging balancing act, because, you know, in some sense, it's only now that the sort of output gap in the UK is closed, and we haven't seen we're only now seeing that sort of build up of domestic inflationary pressure. So I don't think the kind of a path of the economy hasn't really warranted
and the closing of the output gap has happened despite the Brexit fears.
Yeah, I mean, look, you know, it is a sort of funny situation. I mean, I think what you can see is the labour market is really tight in the UK, and that has been true. When you look at across a swathe of labour market indicators, a lot of them, looking at measures of tightness, a lot of them are now sort of flashing read. But at the same time, look, I think it's a brave person on the Monetary Policy Committee at the Bank of England who would vote for a rise in interest rates now, because there's such huge economic uncertainty. And when you look at what's happening with business investment in particular, it's very weak. It's been falling for 4 quarters. You undoubtedly can see the impact from Brexit on the economy. We're growing much slower than we would have done otherwise. But at the same time, the challenge over the long term, and it does depend, obviously, there's a huge uncertainty as to where the UK goes from here. You still have some building inflationary pressure. You can see it in wages are now finally picking up. But the UK, like a lot of other major economies, still has this puzzle where employment growth has been really strong. We've been creating jobs. Yes, we're seeing wage pressure pick up, but it's still not as strong as you might have expected otherwise.
Did the exchange rate play a role in this?
So I think in the UK, I mean, obviously what you've seen is, I always sort of say in some sense the biggest impact that we've seen, well, I would say up until the last 6 months from the referendum, has been the weaker exchange rate and how that's fed through into higher inflation. I'm not sure that's played such a role on, sort of pushing up wage bargaining. I think when you talk to kind of businesses, they say the pressure that they're getting through the labour market is just through skill shortages, and it's just the UK economy has been growing now for several years, and we're sort of just meeting capacity constraints in terms of when you look at measures of the availability of labour, skill shortages across sectors are at some of their highest levels, in manufacturing for all time.
So Lorenzo, would you say that Brexit would affect the European Union economically in a substantial way, or is it just a blip?
Well, economically, there will be certainly a negative impact, but far smaller than what is expected in the UK, that's for sure. The big issue is clearly on the financial side, and there were big concerns about availability of proper finance following Brexit. I think these concerns have now receded to some extent, because central banks have done a very good job to put forward contingency plans and ways to address legally the continuity of contract and this kind of stuff. So I think these concerns are much smaller right now. There will be some kind of reallocation of functions within the Eurozone. I think many financial institutions are thinking here you have to differentiate institutions by institution, and also sector of the financial world by sector, because there are different trends, so to speak. But there is some reallocation. I think, having said that, probably City of London will maintain a prominent role in the financial world even after Brexit. But again, there will be some reallocation of functions, some reallocation of functionality within the Eurozone, and that is inevitable in my view.
I had from the beginning planned that at least here in London we do this also as a more open discussion. So I wonder if anyone here of the other participants would like to contribute, to ask a question or say something about it, especially that we have some academic issues here as well. Anyone would like to say something or share something?
I don't have an academic issue, but I have a technical question relating to what you said, Professor Codogno. You talked about the decline in finance in Italy since the financial crisis, the down by nearly 20%. Is that because banks are worried about lending, or companies are not interested in borrowing, or what are the factors behind that?
I think it's the combination of perceived higher risks on the government, so the stability and the risk premium asked on government bonds, which is impinging on the banks. There is the so-called doom loop between the banks and the government, which also pushes for a different behavior by the banks. So the banks have been cleaning up their balance sheet, reducing their risks, improving the quality of their loan portfolio at the expense of providing loans to the economy. Now, if we believe in the bank lending survey by the ECB, there's been some tightening since the current government took office, which is effectively a way to say that there are not only demand problems, but there are also supply-side problems. And the supply-side problems, again, are related to the combination of not sufficiently accommodative monetary policy, particularly in the early stages of the crisis, and the very tight fiscal environment, given the constraints that Italy has, and pressure by regulation. So if you combine all these factors, the policy environment remains relatively tight, and banks have no choice but to do what they should do. So they're basically cleaning up their balance sheet, reducing their exposure, reducing their risk at the expense of the economy.
Anyone else to this? Any of these questions? Yes.
Yeah, my question would be regarding the normalization of the expansive monetary policy. What is your take on why the ECB has still, despite that the situation was not that good, for slowing down or rebalancing their, or stopping expanding their balance sheet now in December? So what's your take on that? Why do you think that the ECB came to this decision still to go on with their program?
Well, I think back in December, I think there were some policy mistakes made around the world, starting from the Fed, I think. As you know, there has been a U-turn by the Fed later on, early in January, by the way, just days after the decision in December. I think the global economy has been much weaker in recent months than had been expected. And certainly the ECB felt back in December that there was no need to continue. Now, my view is that effectively the ECB has very little tools. Again, I think it was late to deliver back in 2011. It was very late to use its balance sheet. And that's the reason why the ECB had to do a lot more later. In order to address the issue. Now, I think the ECB is constrained what it can do. I mean, we will see on the 6th of June, if I remember correctly, the next policy meeting, which will be quite important because there are many decisions on TLTRO 3, which is the new tool to finance the banks, and then there are ways to mitigate the negative interest rates, which is a huge discussion right now, which might actually lead also to either lower negative interest rates or an extension of the forward guidance. But again, that could be very controversial and very tricky because it might actually lead to further fragmentation of the policy transmission within the Eurozone. That's why it's extremely tricky at this stage to deliver any sort of additional monetary easing.
Yeah, I would agree with that. And although I would also say that there is, I think, genuine concern that buying public debt from countries who are not in the most stable position is potentially weakening the balance sheet. I know that Sebastian is doing a PhD about whether central banks can go bust or not. And I think his conclusion is they can't. But somehow it does matter. And in this sense, for the ECB, there is a credibility issue as well in terms of the assets that they have in their balance sheet. That's point number one, and especially buying up Italian public debt is a serious issue given the government that is in power at the moment in Italy. Secondly, and I think that's true also to some degree was with monetary policy in the UK, they wanted to come out of the extraordinary circumstances so that it gets normal, that if when it gets non-normal again, they still have some tools. Is that right, Ray?
Yeah, no, I think that's right. Though, you know, I suppose the UK has taken a slightly different approach on sort of normalisation to the ECB. And I think, you know, it's sort of interesting to compare and contrast where, you know, in the UK, they've been clear that interest rates will move first before they look at withdrawing QE. And I think the other element in the UK, and it's partly because of the, you know, the structure of financial markets in the UK, there's been more active involvement, I suppose, in the corporate bond market than elsewhere. So I think that's sort of an important mechanism. And actually, I think what's been sometimes underappreciated in terms of how the bank responded after the referendum, because not only did they cut interest rates, but they also, you know, did measures through the term lending scheme to, you know, essentially make it easier for that transmission mechanism to operate through the economy. And I think that did really help to support growth. And I think when people sometimes look back, and obviously Brexit hasn't happened, and that's a whole nother discussion as to the ultimate impact on the economy, but we have seen, you know, there was a policy response to the referendum, and that did insulate, you know, the UK economy from some of the economic effect that we've seen so far.
Right, right. Any further questions here in the audience? Probably in a minute or so we will be moving. You know what? I would like to ask you to sit here so that they can see in the world that we are at the European Institute of the LSE.
Excellent, good point. Thank you.
hohe Effizienz hat. Also von daher finde ich, das ist wichtig, den Konsumenten offen zu legen, eben nicht nur alles zu verteufeln, das hohe Energie verbraucht, weil es in der energiekonsumtiven Industrie ist, sondern auch relative Performance belohnen.
Herzlichen Dank. Es blinkt schon rot hier. Ich weiß nicht, ob Sie das in Berlin auch sehen. Ich sehe es. Vielen Dank für dieses spannende und sehr engagierte Panel.
Ja, das wird auch.
Dankeschön. So, wir bleiben, ja. Wir bleiben sitzen. Dankeschön. Was geht? Ja, gerne, ja, klar.
Was ist das jetzt? Kein Problem. Tschüss. Vielen Dank. Gerne. Danke. Tschüss. Tschüss.
Sie haben ja da, glaube ich, auch noch. Sind wir schon drauf? Are we live already? Yes? Okay. Well, welcome all in Amsterdam and Paris and London, and of course here in Frankfurt, where we've just had our local session. We did it in German, but now we'll switch to English. A warm felt welcome to Roland Backhout, who's sitting in Amsterdam. He's member of the executive board and head of the markets area at ING, the big Dutch bank in Paris. There's Natasha Valla, and is Lorenzo Binismaghi there as well?
Yes, we are. Can you hear us?
Yes, I was looking at the wrong window, I'm sorry. Yes, welcome to you, sir, Chairman of Societe Generale and ex-member of the Directorate of the European Central Bank. And sitting beside you, a very welcome addition, is Natasha Valla. She's Deputy Director General of Monetary Policy at the ECB today in Paris, but Monday back in Frankfurt. Ms. Valla? Okay, great. And yeah, and that was London that we were seeing, Professor Collignon and Rain Newton-Smith. She's Chief Economist of the Conference Board of Industry in the UK, and she can give us a great insight into not only the Brexit issue, but we just had the question of sustainability here, and we're anxious to hear how far along you are, and we'll get to that in a moment. And right beside me here is Professor Joachim Wilmeling, who I'd like to introduce to everyone else. He's a member of the executive board of the Deutsche Bundesbank, responsible for banking supervision. We just heard in the pre-speeches by Peter Brett and by Philipp Hildebrand an urgent call to action. I'd like to summarize it just that way, to getting an integrated European banking market. And I'd like to let you know that within our panel here in Frankfurt, there were different opinions on how far along we were, what needed to be done exactly. And of course, it's clear there are different interests and different views. Now, I'd like to get your take on that, especially, you know, when I listen to Philipp Hildebrand, a lot of people who have to do with the financial markets know this, and they talk about it, but I think it's a warning sign when someone says that, you know, we're at the end of a mature economic cycle, the next crisis is coming, and the ECB and the fiscal policy won't be able to do the same heavy lifting, so it's imperative to make progress on getting the banks prepared for that. Mr. Binis Magi, what's your take? What has to happen now, please?
Well, I mean, there are two aspects. One is the short-term conjunctural developments and how to prepare for the next downturn. But the second issue is what's our medium to long-term goal to make Europe stronger in a global competitive environment. And if you think that the financial sector's usefulness is to serve the real economy, we need to have in Europe a financial system which is as strong and as solid as those of our competitors, and I'm thinking about the US and China in particular. So the question, are we there now? And to be frank, nobody can answer yes. We have to answer, we need to work more in Europe to make our financial system more resilient and more supportive of the economy. And what's missing? I think if we compare to the US and to China in particular, what we are missing in Europe is a deep and liquid capital market which is able to absorb shocks and to finance the economy. And how do we achieve that? There are several elements, but for sure we need a complete capital market union and a banking union which supports this capital market union. And the view that these are alternative ways to finance the economy is wrong in my view. And if we look at the US, this is clearly the case, that a capital market is created by strong banking institutions that are able to trade and to issue and to help the economy and to trade and to securitize and facilitate trade of these instruments.
You mentioned the...
So we need to complete the banking union and to progress in the implementation of capital market union. Now, we know that it's not easy. We know that there are many steps to be done, but we have started. And as many things in Europe, I mean, if you don't go on and if you stand still, you will fall. So we have created a single supervisory mechanism. We have created a single resolution fund. Actually, banks are paying every year to this single resolution fund a lot of money, so we are being taxed. We need to continue this, and the single supervisor and regulators have to create the conditions for this banking union to be completed and to set the conditions, whatever they are, and then to continue towards a capital market union. Otherwise, we are not going to be competitive with the other two main actors in the global economy.
What is going to be in place when the next crisis hits? Nobody knows when that will hit, how it will be initiated, how soon we will know that we are in a crisis. What needs to be in place and what could be in place realistically? I'd like to put the question to the other banker in the round, Roland Bakhout in Amsterdam.
Well, I think a lot has been done. To be honest, I think we still have a lot to do, and there is a definitive need for acceleration in building a banking union. But we should also not completely neglect all the work that has been done. So I think the banking sector in Europe is very well rooted now, on a very solid foundation. And to be honest, it should not be our main concern right now what is going to happen when there is going to be an economic downturn. There is no reason to assume that that is going to be an occasion that we will be faced with in the short term. What is much more pertinent is actually what Mr. Binswagi said, the international competitive environment, and that we make sure that we then are well rooted. Yeah? Part of it is eventually the economic development where we will not be able to compete nor maintain a stable financial sector if they're all nationally defined. It's just not going to happen. It's too difficult, and then we fall back into old patterns. And this is a little bit what we have today. We have European banks in good times and national banks in difficult times. And this is also where we have one of the mental roadblocks that regulators focus very much on. How do I do my homework within the national boundaries that I have, which is then a conflicting direction of what the ECB is trying to accomplish. And it seems to be very hard to get that on the table. And we need to break through that impasse because we have no time. Originally, all thinking about the potential of having a united Europe and a banking union, including a capital markets union, was the upside. Today, on top of the upside, we have an absolute necessity to deal with it because of the, let's say, the polarization that is taking place on the global scale. And our traditional ally, the United States of America, has decided to be more focused on its own interests. China is very ambitious in developing a very prosperous and very successful in developing a very big global role. And Europe is busy debating our national interest versus our European interests. So we need to accelerate that in order to be let's say, in the most solid ground possible.
Professor Wurmling, how to accelerate that? I mean, it's perhaps easier said than done.
Well, first of all, I agree with colleagues who said that the progress which has been made in capital markets union is not so weak as we think. The ideas for capital markets union are already quite old. It's nevertheless a good concept, but the list of initiatives has been elaborated a long time ago. And in the meantime, we have seen dramatic changes of the environment. Roland Bakhout pointed already to the global environment, the political environment, but also the economic environment. We have also seen the development of banking union. We have seen a strengthening of the euro. We have seen new monetary policy. And we have also seen, of course, the dramatic developments of digitalization in financial markets. We have seen new products rising, like green finance. We talked already about it. So maybe there a rethink of the approach for capital market union would be reasonable. We are to start a new legislative cycle in the European Union. We could maybe also think of making digitalization an instrument for the internal market also in finance. You could overcome to a certain extent the fragmentation of the European markets Mr. Smagi pointed to by blockchain, by platforms. And this conference is the best example how to overcome physical distance, to have a common discussion within these places here present today. And kind of this could also happen to capital markets and financial markets in the European Union. And then we should also approach the new developments as green finance, sustainable finance, new products, high liquidity assets, and so on. So give it another push, give it another perspective, give us a fresh thinking about capital markets union to identify the really instructive methods and instruments to bring it forward.
Ms. Valla, in Paris, how urgent is getting ahead on this issue from the point of view of the ECB?
Well, I think I want. Can you hear me? Yes.
Yes, now we can hear you.
Thank you. Maybe a couple of things on the framework that has been discussed, and I would like to single out two quotes from the preliminary remarks by Philippe Hildebrand and Peter Pratt. Philippe said the market sentiment on Europe is too pessimistic at the moment, and I very much share that view. And one of the emergencies we have is to make the information about the health of the European economy, about the true state of the European banking system, as transparent as possible and carry it to investors all around the world. I mean, I realize when I meet investors in the US right now, they're extremely pessimistic about the health of the banking system. Even when you show, the NPL numbers that everybody believes in, there's a mistrust in what happens here in other parts of the world. Well, I think we can correct this build or this image. Now, I think in terms of the issues moving forward, three things maybe, and that covers a bit what has been said before. One, the resilience of the financial system. That's a key dimension. The link between macroeconomic developments and financial developments is something that is now, should be bread and butter when you do policy making, and not only monetary policy making, other policies being shaped. And this resilience in Europe starts with the banks, but also covers other financial institutions in the framework of markets. But this is key. The second dimension is to make sure that the financing conditions for European firms and European households remain favorable. And I think this is something that we need to look at very closely. How levered those entities are, is that an issue, is that a non-issue, and how do we deal with it? And the third dimension, which was not really mentioned here, but I think which is in the back of the mind of many around, is that there is something when we look at the economy today, there's something that we fail to understand, and that's the link between cost developments and price developments, the price formation mechanism. Less speaking about the asset prices than consumer prices. But there's a missing link which we all collectively, financial markets, financial institutions, policymakers, need to understand better, so as to make sure that we have the right objectives for policymakers and that we have the right compass for the pricing of financial instruments. This pricing is made nominally. So I think that would be the main set of questions I would see key at the moment to look at. And in the context of Europe more generally, I think, and Pervenche Berès in our local debate was mentioning it today. I mean, there will be a new legislative team in the autumn, but there are a number of dossiers on the table, and those dossiers are making progress. We are dealing with the reform of the ESM at the moment, and there are lots of things on the table, and this needs to move forward. It probably will move forward.
Bring me up to speed.
Yeah.
Yeah, bring me up to speed, Ms. Valla, when you say the dossiers are on the table. I know in the United States when an administration changes, or here in Germany when an administration changes, people leave, and the dossiers are history. They're filed under P, Papierkorb, waste paper basket. what happens in Brussels with a new commission? You say the dossiers are on the table. Do they remain because there's been so much work put into it with up until now still 28 countries, or what happens? Give us some insight.
Well, I'm not sitting in Brussels, I'm sitting in Frankfurt, but the ECB is also listening to and participating in some of those discussions. No, I think some dossiers, I mean, there's a bit of what you say, but some dossiers have some perennity. I mean, we wouldn't have built the banking union in the way it is now with some erratic movements depending on who comes where. So I think on those key elements, and ESM reform is one, you have a lot of sub-dossiers that pertain to EMU deepening. We'll have to deal with EMU deepening. People have been thinking about what is missing for EMU to be perennial for 10 years now, and the diagnosis is fairly consensual. The answers are utterly unconsensual, but the diagnostic is very, very consensual. So we know we have to address this. So I believe those arguments will still be the arguments we hear today in the dossiers that are blocked, for example, in banking union, will still be on the table with different, maybe a different relationship of power. But I really very much trust that those discussions will move forward. My view would be that we should be, from a tactical and strategic perspective, trying to de-link as much as possible one dossier from the other. Take the example of safe assets, for example. There has been a long discussion on whether, the euro area / the European Union needs a safe asset. What kind of safe assets could we have on the table? That's something that was then, the discussion was, there was a hype around the discussion, lots of propositions being put forward, lots of expressions on all the camps. Now the discussion is a bit, more leiser, more muted, but the need for a safe asset is still there. I mean, speaking from the Monetary Policy Authority, if you don't have a safe asset, you are bound to conduct monetary policy in a kind of suboptimal way. So this discussion will have to take place, and I trust those dossiers, the mobilization will remain there even with the new people around the table.
Joachim Wirmeling of the Bundesbank.
Well, I'm, of course, the temptation to continue discussion about safe assets. We would have abundant safe assets if the economic policy in all the member states would be oriented as a little bit more on stability and budget discipline, but that's only a side remark. As a former official of the Commission and a former member of European Parliament, I would like to come back to your question of whether a new legislator in European Parliament is also a new start. Yes, of course it is. Formally, all the proposals of the Commission remain on the table, but we will see a completely new European Commission. There are only one or two members who remain. We will see a completely new European Parliament with 2/3 of the members changing. And we have a lot of new dossiers on the table, the implementation of Basel III. There will be a revision of MiFID, which is obviously very necessary. We will have the new situation of Brexit. So I'm expecting a fresh start also for the politics of integration of the European financial market. Maybe also new aims, getting more autonomous in financing our industry, our economy, taking into account a new multilateral framework, and so on. So there is, and this is a big opportunity because we have been stuck into a lot of deadlocks in this area.
Let's move to London. Ms. Newton-Smith, you must be listening to some envy with us discussing a capital market union in the European Union and the position you're in right now. Give us some insight. Where is Britain at the moment? We'll be voting in just a few days. Your vote is, I think, on the 23rd of May. A really curious situation. Tell us what you're experiencing there.
So I won't sort of comment on the European parliamentary elections. I think, first of all, though, what I will say is it's great, the UK in or out of the European Union. It's really important that we are having these discussions. So it's sort of great to be here, you know, talking particularly at the LSE's European Institute. I think, and working for the sort of CBI, so we represent businesses across all sectors, across all regions in the UK. And I think from just picking up on the discussion we've had so far, I think the role of financial services in driving growth across the real economy, be that in the UK or across the rest of Europe, is so important. And I think there is a sort of danger that we all naturally fall into, is worrying about the previous crisis and looking ahead to what the next crisis will be and assuming that it will be a similar form of crisis. But actually, I don't think the next crisis will be like the last global financial crisis. I think it will be different, and I think we have seen steps both in terms of what's happened across Europe in terms of recapitalising, and here in the UK in terms of recapitalising the banking system, ensuring that we have better financial market regulation to sort of prevent a crisis like the previous one. I think the challenge actually for Europe is what Lorenzo was sort of highlighting, and others have sort of picked up on, is really thinking about where is the opportunity. Because, you know, we know the US is adopting one strategy and China is adopting another, and the, you know, regulation globally will either be determined by the US, by Europe, or by China. And that's an opportunity to think, where will the next wave of growth come from? And I know in the previous discussions you've touched already around climate change, but that is one of the big, huge transitions, I think, that will be happening in Europe, but across the globe, is that move to a lower carbon economy and potentially a net zero economy. We can maybe come on to discuss that. But the development of the financial sector in supporting the investment we need to see in those new technologies will be vital. And actually, Europe has a huge opportunity to really lead this charge. And I think what the European Commission has done through the European Investment Bank in terms of developing the circular economy, but also more broadly green finance. And if you look at Paris and the development there in terms of the green bond market, again, there's a real opportunity. And I think it's for Europe to think how you scale that and make that more effective. And the other point I would make is, when I talk to businesses and they sort of compare their access to finance in the US versus the UK or Europe, one of the things that really comes back to is the development of capital markets, so certainly equity finance, but I think more importantly, it's that growth capital, which is also about venture capital. And I think where the US still has a big comparative advantage is the depth of that longer term growth capital for businesses. And you can see how that has driven the development of the technology sector in the US. So I think as we move to developing the capital markets union, that should be what's at the forefront of thinking, how can Europe compete in that space? How can we really develop the growth capital so that businesses who are adopting those new technologies can get the access to a range of different finance to really meet that opportunity? So I think that would be where I sort of see the developments going forward.
Lorenzo Albino, you Smaghi in Paris. How much time do we have to propel the CMU along with the Brexit looming, with the elections, perhaps also with a whole different parliamentary makeup, i.e. populists, to get ahead? What is important for you as banks now with the Brexit looming?
To have clarity, that's what we've been asking for months.
A tall order, yeah.
And I guess it's increasingly difficult. But I think the key issue, I guess, going forward will be, after the European election, the selection of the new Commission and who will be the Commissioner in charge of financial markets, and whether he or she will have strong support to really make an ambitious proposal to move forward. I mean, as is coming out from this discussion, the private sector is ready and is willing to contribute. I think Rain mentioned, I mean, Europe has a leadership in, for instance, sustainable finance and all the opportunities that emerge from the private sector. But we need And we are willing to participate in the true European financial system. And let's face it, I mean, to achieve that, we need to overcome the resistance of national regulators and politicians to some extent. We need to move forward and to convince everybody that we can have a strong system only if it is truly European. It's not going to take 5 minutes, 5 days, but it's important to give a sense of direction and a new initiative that really is able to have everybody behind, in particular national regulators, because the biggest effort will have to come from them. They will have to accept that we have a stronger European system if we share these discussions, if we eliminate all these national exceptions that are in European regulation, and we supervise and we regulate at the European level. I think that's the big debate. And of course, if out of the new elections we have a true European Parliament, a true European in the sense that pro-European Parliament, I think this will be a strong push to convince national governments and national regulators to move in that directions. If instead we have a European Parliament which is much more nationalistic, then we are going to the risk going backwards, and this will weaken our financial system and will weaken ultimately the European economy. So what we are looking forward is, after the European election, a strong Commission, a strong Commissioner on financial issues, and a strong sense of direction which is able to lead national regulators in a clear direction.
It's going to be a package with the ECB president, the Commission president, the individual commissioners. Maybe we'll get to that point still. We just happen to have a national regulator sitting here in Frankfurt. Your response, Joachim Wilmeling?
Well, looking to the next months ahead, there will be, of course, also a fight, a political fight, not only as far as the personnel is concerned and the functions, but also what will be the priorities for the next legislature. And when you look to the summit yesterday in Romania, you see that there are a whole bunch of issues which are on the table, far away from financial markets, which are all very important, climate change, foreign relations, and so on. And the financial sector, and also we as regulators, we have to offer a compelling story that finance as a priority for the next European legislature is worth to fight for. Capital Markets Union was one of these stories at the beginning of the last legislature, and we have to let's say, start a little bit more to look ahead, not of nostalgia, what has been achieved, what has been not achieved, and so on, but give it a fresh shape also, and show the contribution to the wealth and the well-being of the people in Europe, because this is the issue on the global level. So it is, from my point of view, it is not at all clear that integrating European financial markets will be a priority of the next European Commission, because it has been proven so hard to do it, and it's not that obvious.
It's not popular.
It's not popular at all. So they are welcome very much. Also the signs of the industry to support that. There is, of course, also the wish of legislators and regulators and also supervisors to support it within their mandate, within their constraints. And we as Bundesbank, we have contributed very intensively to the building setting up of the single supervisory mechanism. We have reorganized ourselves to support it, so we are open to that. But of course, our mandate is to secure financial stability not only in Europe but also in Germany. And there we have, of course, ambiguous goals, but we are ready to support the overall progress.
Yes. Roland Bockut, it demonstrates, the wishes are there, but you have the obligation to look out for our German interests. This is at the heart of the European discussion, how to move forward. There are lots of reasons for not moving forward. That's the problem.
Well, yeah, and so I agree with what almost everybody is saying, but I'm not sure we can, and I like the word fresh, but I'm not sure it'll create the right sense of urgency. I think it is necessary to be critical to what has been done and also, therefore, what has not been done. And I'll be the first one to hand out big compliments to the European Central Bank, which in my view is the only really powerful European institution that makes a difference, certainly when it comes to its monetary policies. On the other side of its, on the other hat that they're wearing when it comes to regulation, I wish that they would be mandated to take more decisions that also impact national regulation, so that they are less hindered by national competent authorities in the execution of European regulation. And I think, that Professor Wermeling is correct. The national authorities have a responsibility to keep their financial system stable, but I'm afraid the order in which they think is not the one that he mentioned, namely European first and then German second. Oftentimes they think the national responsibility first and then the European responsibility, and which is totally understandable, but it's not preparing us for the future. If you look at the European deposit insurance schemes, it's the same thing. Of course, there's national interest in people saying that their banks are stronger or their guarantee system is better. And this leads to an impasse. We'll have to give up something in one country or give up something else in the next country in order to make progress. And what national authorities have to do is to give up authority on behalf of European authorities. And if there is no willingness to do that, then we're not making any progress. And I think the point that is being made is that there is not a lot of time anymore to wait for a miracle and to capitalize on the opportunities. That is still there, but on top of it, there ought to be a sense of urgency in order to move this forward, because we're bystanders at the end of the day if we don't manage to get to this single European market. And therefore, we really need to move forward. I can't emphasize the point enough. And I hope that there will not be a lot of additional files to be created when the European Commission takes its seat in Brussels next. We have plenty of files. We, as a matter of fact, should sift through them, prioritize them, and then start executing on some very plain vanilla, practical facilitators of further European integration, and not come up with other things. One remark that I would like to make to something that Ray Newton-Smith said, sustainability. To be honest, there might be opportunities in sustainability. First and foremost, it's an obligation, to be honest. We need to get our act together and start doing that in a far more effective way than we have so far. Financial institutions play a very important role in making that happen. On a global scale, I'm wary of a reason for further polarization. Whatever we do, I can see debates emerging already that why would we do that while in China they're producing more CO2? The problem is not with us, the problem is with them. Debates like that are happening every day, which, mind you, is a similar debate as saying, I need to take care of my own financial system first before I start thinking about the European financial system. So we can't even accuse the global discussion like that of doing the wrong thing, because even in our own environment we're doing that. So I'm worried about that, and we should move forward.
But everyone's competing with everyone. I mean, your bank is competing with Chinese banks, with American banks, with German banks. So isn't it understandable that there should be some resistance to changing the status quo?
Well, if you look from a European point of view, we are, as Europe, well served by having strong global European institutions that manage to compete with those US institutions and potentially Chinese institutions. Right now, to get to the scale that these institutions are allowed to get to is very difficult in a European market. And a lot of the new entrants into our industry as well that work on a model that has virtually zero cost scalability, taking full advantage of their own home markets, be it the US, be it China, and this is very difficult to do in Europe. Even if we take really excellent legislative decisions as PSD2, again we allow national authorities to have a local interpretation. Instead of facilitating further digitalization within a European market, we make it very difficult for companies to take advantage of it.
Ray Newton-Smith, when we look at the risks ahead, yes, Mr.
I just wanted to add that we compete with ING, but we share exactly the same views on the need to have a true European regulation that ensures a level playing field within Europe and a level playing field at a global level. So I think from the industry we have a similar view of the need of a stronger European and unified European regulation and supervision.
The question is, of course, who's responsible for the regulation in the end? There's going to be a new commission, a new parliament, but the governments, they will remain the same after May 26. I suspect that the main area of resistance is coming from them. What do you think, Mr. Binismagi?
Well, to be frank, if you have a strong initiative by the Commission, that's a good start. Unfortunately, last time we started with a portfolio in the hands of a British, then he had to leave, then somebody else came in. I mean, I think the enthusiasm in the Commission was lost, not due to the Commissioner himself, who was very enthusiastic, but I think we need a new fresh start to convince governments that if they look only at their own backyard, frankly, this will increase fragility of the system. I mean, we were talking a bit previously about national responsibility, but our financial systems are already de facto integrated. So if some parts of the euro area gets into financial instability, you cannot prevent it from having a contagion to the rest of the Union. So you need a supervision and a regulation at the European level. That's the only way to achieve stability and to protect, ultimately, the German, French, Spanish, Italian savers, is to have an overall view. If you only have a limited view, you will miss it, inevitably. So I think that's, of course, you need a step and a political step to understand that. But from our perspective, we are global banks here, we see this very clearly. And so it's a question of initiative, it's a question of strength at the European level, and starting from the Commission, and I'm convinced that the next European Parliament will want to have more powers in these areas. And this, I think, between the Commission and the European Parliament, I think governments will find themselves directed in that direction. I mean, going to that direction. That's our hope, at least.
Thank you for that. Let's move to London. Ray Newton-Smith, and let's perhaps move the discussion along a little bit too to monetary policy. What does it look like in the UK? You're solitary. We have the ECB here, and you have the pound to take care of. The pound's taking a beating. What are the perspectives there from your viewpoint?
Well, look, I think the issue from monetary policy in the UK at the moment is that just there's so much uncertainty on the economic outlook because of Brexit. We still don't know what world we're going to end up. It could be Brexit, it could be no Brexit, or it could be a deal in between. So I think so that makes it very hard for the Monetary Policy Committee to take a decision. I think when we looked at the sort of run-up to where we were in April, what's immediately clear is there was a lot of stockpiling happening in the UK economy. That will have provided a boost to growth in the first quarter of this year in the UK, but uncertainty is still having a hugely damaging effect on business investment. Business investment in the UK has fallen over the last 4 quarters. And at the same time, we were discussing in our previous panel here, you do have, the output gap is fairly closed in the UK. We have been growing for a while, and even though our growth now is weaker, so is our potential growth. And so you're in this challenging situation where we are seeing some rising domestic inflationary pressure, but a pretty uncertain and pretty weak growth outlook. So that means effectively, the Bank of England's Monetary Policy Committee can't take action. I think I would just build on a few points from the sort of previous conversation, and really about this point around sort of leadership and the development of sustainable finance. I think when you look at what's happened in the UK most recently, last week we had the UK Committee on Climate Change advising the UK government to adopt a net zero carbon target by 2050. So it's essentially trying to adopt what was set out in vaguer terms in the Paris Agreement, that countries should adopt a net zero target. So I think that will soon be adopted by the UK government. So we will be the first major advanced economy to have a target to to ensure that we're not emitting more carbon into the atmosphere than we're taking out by 2050. Of course, the big challenge is making sure you have the policy frameworks and importantly, the finance to deliver the investment in the newer technologies to deliver that. And I think I would come back to, Europe now has an opportunity, for the European Commission to really think about having an explicit target themselves for a net zero target. And hopefully that's where we'll end up. But I think as well, there's a huge issue around financial stability. And I think the Financial Stability Board with the task force on climate-related financial disclosures has really tried to highlight that this is a huge issue already for banks. It's already a huge issue for insurers. Here in the UK today, we had our environment Department for the Environment talking about the very real risks of flooding in the UK and what that means for our insurance industry. So I think we will see more of that developing over the next 5 to 10 years. And it would be remiss of me, I think, as well, not to talk a little bit more about the challenges, I think, that a no-deal Brexit would be hugely damaging to the UK economy. It would be a monumental act of self-harm. You can say maybe we won't finally have agency in terms of where we end up, but I think it would be a failure of political leadership here in the UK if that's the situation we ended up on. But I think it would be hugely damaging to the development of the financial markets and capital markets across Europe. It would obviously be mostly damaging to the UK, but I think thinking through what that would mean in terms of loss of access to the deepest financial market in Europe, it still is London. And I think if we end up in a no-deal Brexit, it would be a huge step back, certainly for the UK, but I think also for the rest of Europe. So I think it's something I would say, to European leaders, but also leaders here in the UK, we absolutely need to work together to make sure that that doesn't happen, or we'll end up fighting that fire rather than, tackling the real opportunities there are from further developing the capital markets union or further developing the financial system in Europe, or really making that move to a low carbon economy and all the other technological change that is transforming the global economy at the moment.
The financial industry has prime importance to you in the UK. I don't know if I need to explain to anyone in the room or in the other rooms. You have about as many people working in the city of London as Frankfurt has citizens, and we're getting a few of those over here. What's the feeling when you talk to your members, when you listen to the discussion? We know what our impression is, what the impact will be. We'll get a few thousand people here and rents will go up because well-earning people are coming. But what's going to be the impact in London? Are you going to even feel it? Or will the banks in their operations be really up someone's creek when it comes to business on the continent and internationally? Right.
I think I think it depends what you mean, because we're still facing a sort of range of scenarios. I think if you look at the financial services sector here in the UK at the moment, if you look at business confidence, it's fallen for more than 2 years. That hasn't happened since the global financial crisis. So I think the mood within the financial services industry in London is more pessimistic at the moment. You can understand why. That is partly because of the risk of a no-deal Brexit. I think actually banks and the financial services industry understandably have put in place contingency plans for that event. I'm not worried about the immediate financial stability implications. I think there is enough capitalisation in the banking system in the UK and the rest of Europe to withstand the financial stability shock. But I think the implications for our competitive growth over the long term would be hugely damaging. Of course, the bigger question is, let's assume for a moment we avoid a no-deal Brexit, and if there is, then it's what form of Brexit will we have? And I think the frustration at the moment here in the UK is the discussion in terms of what relationship we will have, particularly for financial services, but also services more broadly with the European Union, what relationship the UK will have. That conversation hasn't even started. We have the political declaration, which sets out at a very high level what that could look like, but everyone knows that trade negotiations are long, they are complex, they take time. And I think politically that discussion about what sort of access we want, what kind of harmonization of regulation we want for financial services, but across all services in the UK hasn't happened. We are still sort of stuck discussing, our access. Being part of a customs union is an important part of the discussion, but it's really only a first step. And I think that's the big challenge for the UK economy more broadly.
Thank you. Joachim Wömmerling.
Well, other than football games, which are at some stage over, the game on markets are never over. There's always a development, and it's today completely impossible to say how the repetition of work on financial markets between London and the continent will shape over the future. Brexit hasn't taken place yet. We as supervisors, of course, we demanded banks to apply for licenses, establish infrastructure, not empty shells all over Europe. But what has been created until now is only the basic infrastructure which satisfies the supervisors. So how the market shares will develop is completely open to the decision of the market participants, but also open to the shaping of attractiveness by European regulators, European legislators. So how attractive the continental financial markets will be in the future, that is up to the decision of the European Parliament, the European Commission, the member state in the new legislator. So here the training is still on.
Thank you. I'd like to direct a question to Ms. Valla, going into the last minutes of this very engaged panel. My impression is, correct me if I'm wrong, whatever happens, the ECB will be there in the end. It stepped in 2012. The Fed and the ECB stepped in 2008, 2009. I assume you're going to be ready to do that again, but we heard in the introductory remarks by Philip Hildebrand, the heavy lifting is perhaps not possible in the same way this time. Give us some insight on that.
And that's true for EMU, and that's true more generally. The monetary policy should not be the only counter-cyclical policy and crisis management policy. So in the euro area, there's also a fiscal stance that needs to be adjusted appropriately to conjunctural circumstances, but also to crisis management. So that needs to be kept in mind at all times, especially because a lot of things have been done, and those things have been very bold on the monetary side for the past, since 2008. And those things have worked. We've measured their impact in terms of stabilizing the economy, stabilizing the financial system, but also in terms of impact on growth, on jobs and on inflation. Now, the second part of your question is what can be done when the starting conditions are the ones we have right now, namely to put words behind the images, with the central bank having a very large balance sheet, with interest rates being at negative levels, and with, so to say, some limited leeway on standard monetary policy instruments. And I would say here, the toolkit is much larger than before, and much larger than what we could ever dream of in the pre-crisis environment. And the skills to use that toolkit have developed over years. And so now I think there's a lot of thinking to be made in terms of the complementarity across the instruments of monetary policy. And I have in mind, the three main families that I mentioned at the beginning: liquidity provision to the banking system, interest rate management, and management not only at the maturities of money markets, but also all through the yield curve, and of course quantitative measures, including, but not necessarily only, purchases of sovereign debt instruments. So this is, someone from the Fed was saying, we have put QE in our cellar. Maybe other central banks have put, QE in the corridor. So in a sense, those tools are here, and according to what the circumstances will be in terms of macroeconomic developments, but also in terms of economic and financial stability, we will be able to use them appropriately, knowing that the mandate remains the one, price stability.
And your neighbor, your Nachbar, sitting right beside you, Mr. Binis Maghi of Societe Generale. You have the insight from having been within the ECB, and now you're in a bank. Your interest should be both financial stability, of course, as a banker, but also at some point having higher interest rates again and making more money. But these risks are looming, and the toolkit might have to be taken out again. So what's the perspective in the next few months? We don't know what's going to happen. Is the ECB ever going to raise rates in the next 2-3 years?
I mean, as a comment, I was in the ECB in 2008 and the following years, and certainly in those days we didn't have a banking union, we didn't have an ESM, we didn't have other things. I think now there are other institutional elements that would allow monetary policy to be much more effective, and to be able not to absorb all the work that needs to be done in a crisis. Having said that, we should not get too obsessed about the next crisis. Maybe we should look at the current environment, and I'm certainly not advocating the ECB to raise interest rates if the conditions for price stability are not achieved. Actually, I mean, I wished we had price stability right now with inflation at 2%, so that interest rates could be raised indeed, but this is not the case. So monetary policy has to still aim at that. The request or the suggestion that we would have for the central bank is to look at all its instruments and whether the use of these instruments are not creating distortions in the economy and are not actually creating perverse effects. And I'm thinking about, in particular, negative interest rates on deposits with the central bank, which actually are a tax on the banking system right now, a tax that only European banks are paying, in addition to the tax that is entailed by contributing to the SRF every year. So the question is this tax really useful in an environment where, the banking system should support the economy? Or are there ways to reduce this distortionary element which comes from the negative deposit rate? And I'm thinking, for instance, what they do in Switzerland or in Japan to maybe have a negative interest rate only on one part, but not the whole all the amounts of negative deposits, so a tiering system. So these are the kind of suggestions I would give to the central bank, and with their independence and their wisdom, maybe they can come up with solutions that reduce the distortions that the current policy environment is creating in the European economy.
Yeah, Roland, Professor.
Yeah. Well, just a small remark. First of all, we also see the risk that the excessive use of extraordinary new instruments in monetary policy entail those unintended consequences. First remark. Second remark, I just want to preempt the impression that a new crisis is immediately coming. Our economists say what we saw in the last quarters is just a normalization of the growth path, because we had, at least in Germany, growth above our potential in the last years, and now it's coming down to potential. Our economists also say that a growth period has no natural end. Looking back 100 years, all the recessions were caused by external shocks. So growth periods, they don't die, they are killed. So nobody should in this situation expect, because of the long-running growth period, that the downturn is just around the corner. This is not the case, and it depends on the fiscal policies, the budgetary discipline, structural reforms, and so on in the euro area, whether that growth is persistent. And it's not something in the air which comes out of the sky. It's up to us. It's our responsibility to keep growth going.
Thank you very much. We have about a minute left. Not enough to formulate a question the way I ask questions, and certainly not enough to give a qualified answer. So let me thank you very deeply for this discussion. First experience for me working with different rooms. It was a great pleasure. Thank you, Natasha Valla in Paris and Lorenzo Bini-Smaghi in Amsterdam, Roland Bakut in London, Ray Newton-Smith. All the best for the coming months. And here in Frankfurt, Joachim Würmeling. And thank you in the audience.